what the new Regulation A really means to your company. This is not legal or investment advice. Seek competent advice. This is only a summary. You want to study the rules in depth. Your situation may vary. The more you know about finance and business, the more you can profit. The new Regulation A, which has been called Regulation A+, was recently announced by the SEC. Creates two tiers of Regulation A offerings. Tier 1, offerings up to $20 million in a 12-month period, including up to $6 million of securities that can be sold for the account of selling security holders. Tier 2, $50 million in a 12-month period. Selling security holders can sell $15 million worth. For offerings up to $20 million, the company can elect whether to proceed under Tier 1 or Tier 2, but audited financial statements are needed for Tier 2. And importantly, Tier 2 offerings are exempt from state blue sky regulations. The rules will take effect 60 days after publication in the Federal Register. What we're going to do now is look at the factors that are important to you as company management. Okay, we believe the following factors are material to your decision to use the new rule. First, audited financial statements. First question you ask yourself is, how long will it take to get the money? If you can get the funds faster than your competition, you win. The speed of funding largely dictates how fast you can grow. Second question, what is it going to cost me in out-of-pocket cash before we get to the money? If you have not been getting audited as part of your historical operations, it will take time to get the audit done. Accountants, in my experience, are almost always late. They can run into unforeseen issues you have in your books, or they can just be slow. Once an accountant is engaged, you're pretty much stuck with them. An accountant can drag out the work, and if you replace them, it will cost you more time and money. Now with Reg A+, if you want to raise a small amount of money, you can offer stock without an audit and hope that investors who do not know your company will trust you, or you can wait and pay to get the audit. You do not need a full PCAOB audit. You may have an accountant who's familiar with your work and can do a relatively fast audit. I would suggest, however, that you compare the cost of a non-PCAOB audit with a PCAOB audit to see if you might prefer the PCAOB audit. Now, other issue here, state blue sky laws. State filing was one of the reasons old Reg A was not much used. If you wanted to do an offering in many states, your blue sky fees were huge. Even in one state, the state regulator could hold you up for what seemed like forever. You would almost inevitably subject to merit review in states that you wanted to sell in, and these rules impose severe, if not impossible, limitations on new speculative companies. Many years ago, I had one state regulator tell me off the record that his state would never approve a Reg A offering. Presumably, they intended to delay it until the issuer gave up. Now, under Tier 1, you can have one state designated as the lead state for coordinated state review. However, you may still be stifled by stringent merit review in a merit review state. In Tier 2, you are exempt from state filing review. However, you have to face the delay and expense of getting an audit. Next issue, advertising. If you have exhausted friends and family fundraising, advertising is vital. You have to either get an underwriter who would do a small deal, and believe me, there are very few of those, or you have to have an effective promotional campaign. These campaigns cost money up front and are much more likely to succeed if the company's in a hot industry. If the issuer is limited to a tombstone ad, sales will be hampered. While Tier 2 seems to have few limits on the presentation itself, in Tier 1, almost all states limit your advertising to a tombstone ad. Now, you're allowed to test the waters. That can be useful in seeing if the offering is viable without committing to the whole cost. But a huge marketing effort is often needed to place stock in a new and unknown company. This is the type of company we might think of as a crowdfunding company. A limited amount spent on testing the waters may not be enough to show a sufficient response to create confidence in the issue's marketability. You may be interested to know that approximately 12.4 million U.S. households are accredited investors based on either income or net worth. Most have not invested in the types of deals contemplated under the new Regulation A. Speed of processing, another important issue for you. The SEC was kind enough to provide a very enlightening discussion of the existing ways to raise up to $50 million. The SEC reported the average offering under the old Regulation A took 300 days to qualify with the SEC. We doubt that many companies would use any avenue to raise money if they knew it would take 300 days just to start selling after the delay involved in preparing the filing. If it takes 3 months to prepare the filing and 3 months to place the deal, 480 days could have elapsed between the decision to go and having money in the bank. This is impractical. SEC statistics reveal that Reg D Rule 506 was much more popular than the old Reg A. If it takes 300 days to qualify as it did under old Regulation A, you would have been much better off filing a full S1 IPO. In calendar years 2012 to 2014, only 26 Regulation A offerings were qualified by the SEC. Compare this to 11,228 Reg D offerings in 2014. That would have been potentially eligible to be conducted under the new amended Regulation A. Of those, 10,671 relied on Rule 506. Okay, consider the time to completion for a Reg D Rule 506 offering. Using the same 3 months to prepare, 3 months to sell, that gives you less than half the time of an old Reg A offering, assuming only accredited investors subscribe, so there's no state blue sky review. If the time to qualify with the SEC does not accelerate, you will see more companies opting for private placements, including Rule 506C, which allows advertising to accredited investors. After doing a 506 offering, the company can then file to go public. Now, resales by affiliates. One of the more sensible provisions of some state securities laws is to limit fast resales of insiders. It forces the insiders to develop the company in order to take profits. Reg A Plus allows 30% of the stock to be sold to be sales by existing holders, even if the issuer has no net income from continuing operations. Now, as we know, many successful startup companies that have been acquired at huge prices, have never had net income. Allowing the insiders to sell is very beneficial if the insiders have been making a large financial sacrifice to build their company. Selling stock allows the key executives to get back in a decent financial condition, but investors may be less enthusiastic about an offering if they see large sales by insiders. Secondary market, another important issue for you. Secondary trading is important to those who want to sell their investment, be they investors or insiders. The exit strategy. The Reg A company can trade on OTC markets pink sheets, giving the company limited visibility and costing $4,200 a year. To move up to OTC markets, in OTC markets to OTCQB status, you have to pay $10,000 a year. These are not very attractive options. Pink sheet stocks are shunned by serious investors. Costs are important to small companies. Now, the SEC believes that Tier 1 offerings will be conducted by issuers that are unlikely to seek creation of a secondary trading market. The new Reg A may be used by companies that do not want a secondary market, but are simply seeking to take in money in lieu of classic venture capital. These companies may have failed to get venture capital. They may not be willing to accept the terms offered by venture capitalists. Reg A Plus amends Exchange Rule 15C211 so that the issuer's ongoing reports filed under Regulation A and for Tier 2 companies gives the information you need to have a market maker file a quotation. Now, there are advantages in foregoing venture capital money, instead seeking private investors. Venture capitalists may drive a harder bargain than private investors. The company insiders will not have to give up a large degree of control, and the company can advertise widely in a Tier 2 deal. All investors like to have an exit strategy. Now that strategy could be an immediate secondary market, registration rights, or some other method. Rule 144, another thing you want to look at making your decision. Rule 144 is very, very important to small growing companies because it allows the resale of stock purchased outside a public offering. Having an exit strategy like this encourages investors to write checks. Under the new rule, Tier 2 ongoing annual and semi-annual reports do not satisfy the current information requirements of Rule 144 for the whole year. So what you need to do is to have quarterly reporting to get adequate public information for Rule 144. The company can voluntarily submit on Form 1U quarterly financial statements or other information necessary to satisfy Rule 144. If you want to register your Reg A securities under the Exchange Act, you file Form 8A. Now, let's look at how this might be applied to a typical developing company. Some believe that this is a great boon to companies that need crowdfunding. We assume that a company like this has a hot new technology, one that might grow rapidly with proper funding. Typically, such companies are making losses to get developed. The founders are taking limited salaries and have invested most of their own capital. The company is seeking outside investors because it has exhausted friends and family. The company may or may not have angel money. It may not have successfully gotten venture capital, or it may find the VC terms are too rich, and the founders may not want to give up control. Often the company does not have large cash reserves to pay for upfront costs for an offering. Being publicly traded will help the company attract money as it will allow investors to have an exit strategy. So how would the new Regulation A impact this type of company? In terms of time, if the offering is processed rapidly, the new rule may help. In terms of time and money, the company has a key decision to make in getting an audit or not. Personally, I believe an audit will increase the marketability of the deal because an audit will increase investor confidence. Further, a company without an audit can only trade in pink sheets. However, the company must be careful in its selection of an auditor. Now, always with small companies, you need a huge marketing effort to overcome the fact that the company is unknown, overcome the prejudice against small companies. The new rule may be of some help here because if the company is Tier 2, it can advertise. Summary. Small issuers have to look to the time and expense of getting an audit and weigh that against the cost and limits of state rules in Tier 1. The issues presented are time, upfront expense, restrictions on advertising, and merit review. As an audit will create more trust, it may be desirable for market reasons. The audit will move the company into Tier 2, which may allow the company more options for advertising. In Tier 2, the company will also escape state merit review, and the company should carefully consider how it wants to approach having a secondary market for its securities. Overall, any rule which increases the options of small growing companies is a good rule. Much will depend on how it is implemented and the speed of processing filings. If I can help you, you email me at john.lux@securities-law.info. Securities-law.info. There's my phone number, 240-200-4529. You can get my books on Amazon, like How the Shorts Raid Your Stock, Destroy Your Company, What to Do About It, Bash the Stock Bashers, How to Find a Home Run Stock. Look forward to hearing from you, and best of wishes on your venture.